Hey, good morning, everybody. Dale here with TerraVest Capital Partners. It's another Saturday morning. Today is Saturday, October 26th, and it's another beautiful day here in Minneapolis. A nice fall day with the leaves changing. What I'm going to try and do this every Saturday. I hope everybody had a great week. I'm going to be doing this every Saturday, trying to bring news and updates from the alternative asset world when it comes to real estate investing, the alternative asset world. Developments that have happened over the week. Some weeks I'm not going to have much to report. Some weeks I'm going to have a lot. Matter of fact, this week is one of those weeks when there's a lot to report. So I might end up doing a couple videos because the individual topics are relatively important and I don't want to bury the headline in any one video. So there's probably going to be a few videos that I'm going to have to make today. But first I wanted to address why am I putting this content on LinkedIn? When it comes to real estate investing, and what most people think of real estate investing, you can go to YouTube and you can go to the other social media channels and find all sorts of that type of content of what people consider or think about when they think of real estate investing. So there's a lot of content that teaches you how to be a wholesaler, how to do fix and flip, how to buy and hold and be a hold for rentals, and things like the BRRRR method and all of that. You won't see me talking about any of that. That is what most people think of when they think of real estate investing. And whenever I present to a group of real estate investors, I got a presentation coming up next, I think it's next week, to a group. Inevitably, people tell me, hey, I've never heard of the things that you're talking about. And I try to open their minds to new things when it comes to real estate investing. I've had people attend my presentations that have been real estate, what they call a real estate investor, for well over 20 years. They own multiple rental properties, and they'll come up to me afterwards and said, I've never heard of any of this stuff before. I've had real estate agents and people in the mortgage industry tell me that they've never heard of the things that I talk about and that I share with you here on LinkedIn and on my videos. So yeah, it is what I share is a very unique message, and it's something that is not widely taught or widely known amongst real estate investors. But investors, sophisticated investors, definitely know about this type of stuff. It's been around for decades, and you're just starting to maybe see more content around that. So why did I choose LinkedIn? And I'm going to have to look at my notes so I don't end up going down on tangents. So why am I choosing LinkedIn? Because the type of real estate investing I'm talking about is really, I need to connect with the investor class. Now, some people might find that somewhat offensive, that, oh, the investor class, maybe it sounds elitist. Well, I tell you what, the reality is the reality, and some of the things I may say here on my profile and on my videos, people might find offensive, but I'm just going to be real about it. There is an investor class, and then there's the general public, and I'm trying to reach out to the professionals and the investor class, because there is a different language that's spoken amongst advanced or sophisticated investors, and what I talk about is more sophisticated form of real estate investing. Most people that do real estate investing, they focus on the asset, and they're equity investors. What I talk about and what I share is the debt side of real estate. We're debt investors. We're not equity investors. We control real estate by controlling the debt. We don't really want the asset. We want the debt. So I'm attempting to connect with sophisticated investors, and oftentimes professionals and sophisticated investors, they're busy professionals, and they don't have time to manage properties and go out there and start wholesaling and what have you. And they also need to be passive, right? You're a busy professional. You got your career, but you do want real estate exposure, but I need to be passive. And debt investing debt investing is where you're going to find that. And I tell you what, in my videos, I'm going to do one takes. I hate editing videos. So if I hiccup or whatever during it, I'm not going to be editing anything out. I'll try and do these in one take. And hopefully I don't ramble on some things, but I'm going to follow my notes. So I'm attempting to connect with, or I want to connect with and speak to the investor class, the sophisticated investor, the working professional that wants real estate exposure. I love the markets. I'm a very active trader. I love options trading. The financial markets are fascinating to me, and I enjoy being a part of it. But we know that there is a different language when it comes to the investor class. People that are looking for alternative investments or passive investments. Now, oftentimes, I know many fund operators, and the vast majority of fund operators I know are multifamily syndicators. And we're going to be talking about multifamily today. That's the main topic for this, the stress that's happening in multifamily and the opportunity that stress is presenting, in my opinion. And a lot of my associates are seeing the same thing, and that's why you might be seeing more of this type of content on LinkedIn and maybe some of your other social media channels. I only post on LinkedIn. But inevitably, when I have conversations with working professionals, they're talking about investing in a multifamily syndication. And certainly it's the case. For some reason, dentists and doctors love to talk about the multifamily syndication that they're a participant in. Now, one thing that we can understand as market participants, whether you're an equities investor or whether you're an income investor, meaning you're investing in treasuries and bonds and things like that, as market participants, we understand that real estate is a market just like any other market. And we can certainly be aware that there has been a regime change. The real estate market that we've known for the last 15 years that has been supported by artificially suppressed interest rates, that's gone, right? That since the great financial crisis, anybody that is a market participant really is probably going to be very aware that no, the interest rates we've had for the last 15 years have been artificially low and artificially suppressed. And we recognize when there's a change in the market, and we're in that regime change now. Matter of fact, we're in a couple regime changes because we started a rate hiking cycle during COVID. So that changed the dynamic that we've known for the past 15 years. And then we had a couple years of rate increases, quantitative tightening. That certainly changed things. And now we've begun a rate cutting, very minimal, but rate cutting again. So we're shifting, and the market shifts. As an investors, we need to recognize when markets shift and look for the opportunities in those new market dynamics. And I'm certainly seeing a lot more I'm seeing the opportunity that's coming as a result of these dynamics that are in play. But it's interesting, and the reason I say that sophisticated investors or the investor class know a different language is I continuously have conversations with real estate agents and people in the mortgage industry that thought for sure that once the Fed started cutting rates, we were going to see mortgage rates fall. Now, if you're an income investor or if you are a duration investor, meaning that you buy treasuries and bonds and what have you, we all know what's happened to the 10-year since the Feds did their 50 basis point cuts. While everybody was assuming that mortgage rates were going to start falling, if you're watching the 10-year, we see what happened. Today is Saturday the 26th. Yesterday, we hit 4.2. The 10-year has been going up. Mortgage rates are connected to the 10-year Treasury, not what the Fed is doing. So while the general public hears that the Fed is going to start cutting rates, oh good, mortgage rates are going to start falling, the investor class and the people that are paying attention to the bond market see, it doesn't work that way. Mortgage rates are not going to start falling because the yield on the 10-year is going the wrong way. So we do have different conversations amongst the general public and the investor class. And again, my content is intended for the investor class. So my message to anybody that is an investor and looking for passive returns, real estate exposure, and passive investing in real estate, be very, very cautious of multifamily and multifamily syndications. Now, if you're my opinion, There was an opportunity during COVID, and there was a building boom. Multifamily syndicators got greedy. There's no doubt. If you are a multifamily syndicator and you're watching this, this is maybe your project is doing great and that's not a problem. But nationally, multifamily they got way too greedy, and there was a lot of overbuilding, and we're still seeing inventory coming onto the market. So if you are a passive investor and you're being pursued by people that are doing a multifamily syndication, all I'm going to say is you better damn well know your numbers before you put money into a multifamily syndication. You better know the market that you're investing in, know what the absorption rates are, how many projects are in the ground in that market right now, how many vacancies, what's the absorption rate, how quickly are things being absorbed, the project that you're being asked to invest in, what's their plan for filling those vacancies? Are they going to be giving away 2 months free rent, free cable, free gym, all these things that were going to go into the net operating income based on the projections or the pro forma numbers for that project? Are they going to be giving away the farm to fill the vacancies? Because if that's the case, those original numbers and those pro forma numbers ain't there. The narrative has changed. So I would challenge, if you're an investor, challenge the multifamily syndicator that might be pursuing you to show you the numbers, not just the pro forma numbers, but the actual numbers. What's going on in that market, and how is new construction Class A multifamily, how are they filling those vacancies, and what is the inventory that's going to be coming on over the next few years? If you're just now going into the ground, what is the inventory coming on the market over the next 3 or 4 years? And again, I would challenge them. So right now there's a lot of stress in the multifamily, and where there might be tragedy for some people, that presents an opportunity for the other investors. We can go back to the Warren Buffett statement of, be greedy when others are fearful and be fearful when others are greedy. Apply that in this situation. If multifamily builders got greedy and they overbuilt, that was the time to be fearful. Now we're starting to see the stress in that market. And I think now that they're getting fearful, it's time for debt investors, not equity investors, but debt investors, to start getting greedy and watching for those opportunities. And those are the things I'm going to be talking about in my videos. So let me look at my notes here. Yep. Know your numbers, absolutely. So I'm going to talk to you. So how do I know my numbers? And any article that I talk about in my videos, I'm going to post a link to. I'm not here to give you financial advice. I'm going to certainly give you financial opinion, and it's my opinion based on what I'm reading and what I see going on in the market and in the data. But I'm going to share any resources that I cite so you can read it for yourself and create your own opinion or your own thesis about what's going on. But when I talk about numbers, I'm going to share some numbers right now. I'm pulling these numbers right from the quarterly FDIC filings. Every FDIC insured bank files with the FDIC once a quarter. Right? They open the kimono so we can see what's going on in their loan portfolios. If they're FDIC insured, they're supposed to be releasing this information. I read that information every quarter when it comes out, so I know what's going on. So when it comes to the debt, let me see. Let me do this first. Even though I've been seeing the stress, and some of my cohorts in the debt space have been seeing this stress as well, we haven't been seeing that stress come onto the secondary market for the debt investors to buy or make bids on. So it's always good to see information that validates the thesis. So something that came out this week, making the rounds. I'm going to go to my article right now so I can pull it up. And again, I'm going to share the link to this in the down below or whatever. But this is PGIM, PGIM, and if you're familiar with PGIM, very, very large financial powerhouse. PGIM and Citymark bet on multifamily debt as refinancing wave looms. We've been hearing about this wall of refinancing that's coming. It's still there, folks. The wall is there, and it's not going to go away, and it's got to be dealt with. So PGIM and Citymark, they've set up a $500 million fund dedicated to acquiring senior loans and other structured positions backed by multifamily assets. So PGIM and Citymark have set up a $500 million fund to buy distressed multifamily debt from the banks. Pretty much the same things I talk about in my videos of when a bank sends me a tape of non-performing loans that they're getting ready to sell. PGIM sees that too. So little old me sitting in my home office here in Minneapolis is seeing the same thing that PGIM says or is seeing. And you know what? I'm not going to do the I told you so thing, but the reality is the reality. And it's not just me. They're setting up a $500 million fund, and they talk about $650 billion in multifamily debt that is scheduled to mature between now and 2026. So over the next year, it's there. Matter of fact, I'm going to give you some numbers off the FDIC filings from the banks. Let me find it here. Yeah, here we go. Okay, so this is multifamily. And again, I'm reading this right off the FDIC filings. Now, it's public information. You can go find this information. I'm not going to teach you in my videos, how to go to the FDIC filings and read them. Figure it out for yourself. That's what I did. There's no information out there. But point is, it's public information. So what am I seeing? Non-performing multifamily and apartment loans and REO information. And this is as of the second quarter of 2024. Third quarter numbers aren't out yet. And I'll definitely report on the third quarter numbers. The banks are very, very slow to do these FDIC filings. So believe it or not, some of them still haven't done their Q3 filings. And I can only report what's been updated. So as of the second quarter of 2024, there was $2.98 billion of non-accrual multifamily apartment loans in the United States held by 293 banks. Non-accrual simply means that the bank has, they break it down into 30 to 89 days late, 90 days plus, kind of sits in that 90-day plus non-performing. Once they finally decide that, all right, this loan is not performing, they put it in the non-accrual bucket. And so that's $2.98 billion of non-accrual. So PGIM's setting up a $500 million fund, and there's $2.98 billion worth of non-accrual multifamily. Some of it, sure, some of it will be refinanced, some of it will be worked out, but a lot of it is going to end up getting sold by the banks. I would hope, at least, a lot of it's going to get sold by the banks. We're watching for it. We're looking for those opportunities. Yeah. And now that brings me to the second point. This debt has been sitting on these banks' balance sheets, and they've been kicking the can down the road. Call it extend and pretend. Talk to any banker; they'll know exactly what you're talking about when it comes to the term extend and pretend. But they've been extending these loans, pretending that it's going to magically get better somehow. And meanwhile, this debt burden has gotten larger and larger and larger and larger. And the Fed finally this week called them out on it. Let's see, New York Fed calls out dark side of extend and pretend. I was actually very glad to see, a little bit late in my opinion, the Fed could have been a lot more proactive in calling out and putting pressure on the banks to move some of this bad debt off their books. But finally, and this is dated October 25th, yesterday, New York Fed calls out the dark side of extend and pretend. So at least there's an adult in the room somewhere. But again, they're pretty late to the game on this one. They could have been putting pressure on the banks a lot sooner to be more proactive in what to do with the debt, because the debt's still there. So again, this is the type of things that I'll be sharing and that I do share. And it's an opportunity. It is definitely an opportunity for the debt investors. And so the message I typically always close with is, if you are an alternative investor, you're a passive investor, the debt side of real estate may sound intriguing or interesting to you, reach out to me, DM me, shoot me a message here on LinkedIn. I'll be happy to have a conversation with you, share with you the strategy that I follow here at TerraVest Capital Partners. I will be posting a video that breaks it down. I was on somebody's podcast last week where I did a PowerPoint and I just broke down the process for them. As soon as they send me the copy of that, I'll post it here so you can see my process, the methodology that I apply to delinquent debt investing in real estate. But if you are a passive investor, or you need to be passive, and you have a rollover IRA or a self-directed IRA and it's just sitting there with cash, again, I'm not giving you investing advice. I'm just presenting the idea that you can invest in a self-directed IRA in real estate and in real estate debt. You just need to be speaking to a custodian that understands the process and understands real estate investing out of a self-directed IRA. But if you've got money sitting in a rollover IRA from a previous employer, or it's a self-directed IRA and it's just sitting there in cash not doing anything for you, this might be something that you want to take a look at. Reach out to me here on LinkedIn, and I hope to see you in future videos. Have a great day, everybody.